Welcome back to the deep dive. You know we love a bold financial prediction here, but today's headline, it's so audacious, it really moves beyond hype. It demands, well, immediate surgical dissection.
That's putting it mildly.
Right. We are plunging into a recent Wall Street analyst report. And this report, it makes these enormous triple-digit gain predictions for two specific crypto assets.
That's right. We're looking at a projection claiming one token could deliver a potential return of, get this, plus 345%,
Wow.
and the other, clocking in even higher at an incredible plus 355%.
Okay, that's huge.
And crucially, these aren't, retail influencer claims pumped out on social media. These are numbers coming from the sophisticated world of traditional finance, TradFi.
Which forces everyone to stop and ask, are these targets actually based on some groundbreaking fundamentals? Or are they just, well, a play for attention in what is still a highly speculative market?
Exactly the question.
Okay, let's unpack this then. Our mission today, and this is based on the proprietary sources you've shared with us, it's not to treat these picks as gospel.
Yeah,
Not at all.
definitely not.
Our job is to dissect the logic underpinning these predictions. We want to understand, what specific technological or regulatory or adoption catalysts Wall Street is actually betting on here.
And maybe more importantly,
Right, and more importantly, what weight do these analytical reports really carry in the crypto market? A market that's often driven by completely different factors: sentiment, community buzz, sometimes just outright mania.
yeah, you hit the nail on the head. And this is where we have to start at the absolute critical disclosure. These predictions, especially when you're talking about approaching 400% gains, they are fundamentally high-stakes gambles.
High stakes indeed.
They come tethered to commensurately extreme risk. So for you, the listener, these targets must be viewed as signals. Signals indicating where established institutions see potential. That's it.
Not as mandates for allocation.
Precisely. Due diligence is completely non-negotiable, and let's be crystal clear. There are absolutely zero guarantees in assets this volatile. None.
It's crucial we emphasize this point right from the jump. The initial core takeaway here is that we are using these extreme predictions as a powerful research signal. Nothing more, nothing less. The fact that a large financial institution is willing to put its reputation behind a specific type of project, well, that tells us something, right? It tells us where the quote-unquote smart money is focusing its attention within the broader crypto ecosystem.
It's a signpost.
It is. It's a starting line for your own research, definitely not the finishing line of a successful trade.
And we should also address the lack of real specificity here in the source material.
Yeah.
They refer to these as crypto Bitcoin and crypto XRP.
Right, which isn't a specific token ticker.
Exactly. So we need to analyze this not as a, let's say, a specific token picks failure, but more as an analysis of two distinct investment archetypes. We're breaking down the case for, say, a technology-driven layer 2 moonshot
Okay.
versus a regulatory clarity and institutional adoption play. Two different beasts.
I appreciate that clarification. That makes a lot more sense. So we're really analyzing the thesis behind a potential plus 345% technological gamble versus a plus 355% regulatory bet.
Precisely.
It turns the analysis from just, passively reporting on some numbers into a really valuable thought exercise about these differing risk profiles.
That's the goal.
Okay, so before we jump into the specifics of these two high-stakes bets, let's quickly set the stage. What's the current crypto landscape looking like right now? Bitcoin and Ethereum, the undisputed heavyweights, they've certainly been weathering some storms lately.
Oh, absolutely. We recently come out of a phase of correction that definitely cooled off some of the intense exuberance we saw earlier in the cycle. Right now, the market sits in this careful, almost highly sensitive equilibrium.
Tenterhooks.
Kind of, yeah. While the fundamental network usage for both BTC and ETH, that remains robust, their price action is increasingly tied to global macro pressures, specifically the ongoing drama surrounding interest rates.
Right. Higher rates, or even just the expectation of rates staying higher for longer, that acts like a gravitational pull on risk assets globally, doesn't it?
It does.
And crypto, being pretty much the ultimate risk asset, well, it feels that pressure acutely.
Precisely. And you add to that global macro tension the layer of regulatory uncertainty. Statements, proposed bills, or actions from key jurisdictions like the US SEC.
Always a factor.
Always. Or even clarifying frameworks emerging from, say, Europe. These things create sudden pockets of optimism, or conversely, really rapid drawdowns. The market is just constantly reacting to regulatory news. It's become a dominant narrative now, sometimes even overshadowing a pure technical development.
Which brings us to a more fundamental structural question. Why does the crypto market, unlike traditional finance, continually attract and sometimes actually realize these massive outsized return calls? If an analyst projected a 300% gain for a mature company like, I don't know, Tesla or Nvidia.
They'd be lamped out of the room.
Exactly. But here in crypto, it's considered bold, maybe, but still somehow plausible. Why is that?
Well, it really boils down to inherent structural dynamics and, frankly, market maturity.
Mm-hmm.
Traditional assets, stocks, bonds, commodities, they're highly mature, heavily regulated, incredibly liquid.
Right.
Their market caps are enormous. It takes staggering amounts of capital just to move the needle by even a single percentage point.
Crypto.
It's different. It's still a relatively nascent developing asset class.
Still finding its feet.
Exactly. And the underlying projects often possess small to mid-range market capitalizations, especially relative to the potential size of their total addressable market, or TAM.
So the base is just so much smaller, and the potential multiplier effect is massive. A relatively modest influx of institutional capital that would barely even register on the NASDAQ.
Can become a seismic event in a mid-cap crypto token, absolutely.
That makes sense.
This inherent volatility means that even a single successful technological breakthrough, or maybe a major partnership announcement, can move the price exponentially. Think about it. If you successfully capture even a tiny sliver of the global payment infrastructure market,
Yeah?
your valuation isn't going to go up 20%. It'll likely be an order of magnitude higher, potentially.
Okay, let's identify the key structural tailwinds then. What's supporting this kind of explosive growth potential right now? What are the big drivers Wall Street is watching?
I think there are three major forces we see providing significant propulsion right now. The first is the continued evolution of decentralized finance, or DeFi.
DeFi is always moving.
It is. And it's moving far past the initial iteration of just simple lending and borrowing. We're now seeing the development of really complex derivatives like perpetual futures tied to real-world indices, even sophisticated structured products. This complexity, that's what attracts institutional sophistication. It offers hedge funds and larger players these high alpha opportunities they crave.
Okay, so DeFi evolution is one. What's two?
Second is asset tokenization. This is the big idea, right? That eventually nearly every traditional asset, think private equity funds, fractionalized real estate, you name it, will be represented digitally on a blockchain.
And the everything on-chain thesis.
That's the trillion-dollar opportunity, potentially. If you believe the future of finance is fundamentally on-chain, then you're actively looking for the protocols that will facilitate this massive shift.
Makes sense. And the third tailwind.
The third tailwind, and this is probably the most direct driver of these massive predictions we're talking about today, is the continued, and I'd say accelerating, flow of institutional capital.
Right. Not just ETFs.
No, this isn't just about passive ETF buying anymore. It involves large corporate treasuries exploring stablecoins, venture funds actively seeding entire ecosystems, and professional traders seeking out precisely these kinds of asymmetric bets. Which is exactly what a 300% plus target represents.
An asymmetric bet.
Yeah, exactly. They're looking for that small asset that has the potential to solve a huge global problem. That's the hunt.
Okay, now we get specific. Let's dive into the thesis itself. We're analyzing the two projects targeted for these massive gains. The technological bet, crypto Bitcoin, targeting plus 345%.
Right.
And the regulatory bet, crypto XRP, targeting that slightly higher plus 355%. Let's really analyze the rationale for putting such, well, lofty goals on these two particular archetypes.
Okay, let's start with pick A, crypto Bitcoin, the one targeting the plus 345% gain. Based on the analyst's language in the source material, things about technological leapfrogging and leveraging established security, this pick is clearly framed as some kind of layer 2 solution or maybe an interoperability protocol built specifically around the existing Bitcoin network.
Okay, so the project overview for this crypto Bitcoin archetype is pretty straightforward then. It's trying to solve Bitcoin's well-recognized limitations, right? Like its lack of native smart contract functionality, its relatively slow transaction speed compared to newer chains.
Yeah.
So the project's roadmap, presumably, would focus intensely on enabling complex applications, particularly DeFi, to be built securely on top of Bitcoin's incredibly robust security layer.
That's the value proposition.
And the core differentiator is trying to inherit the immense brand recognition, the trust, the decentralization of the main Bitcoin chain, while somehow offering high throughput and low fees like a layer 2.
And this is where we dive into the actual bullish thesis, why the plus 345% prediction. The primary drivers cited in the analysis seem to hinge on key technological breakthroughs. This could involve, say, the implementation of a new sidechain mechanism,
Okay.
which allows transactions to occur off the main chain and then later be settled securely back onto it.
Right.
Or maybe it requires a new opcode that's a technical instruction within the Bitcoin script itself that drastically reduces the friction involved in transferring assets between the main layer and this new layer.
Right. Just to clarify for listeners who might not be deep into developer jargon, an opcode is basically a fundamental command, like a basic instruction, that lets the network perform specific tasks.
Good clarification.
So if a new, really efficient opcode gets introduced, it's almost like giving the Bitcoin network a powerful new function it didn't have before. It could open up entirely new use cases.
Precisely. And the analyst is betting that these kinds of technical enhancements will act as a magnetic catalyst, drawing in serious institutional interest. They'd likely point to massive potential partnerships, maybe with custodians or even large asset managers.
The kind of players who need that Bitcoin security.
Exactly. They require the ultimate security of the Bitcoin chain for their client offerings, but they need the speed and functionality of a layer 2 to actually make it practical.
I see. And I imagine the tokenomics will also be pretty integral to this prediction, too.
Oh, absolutely critical. A successful layer 2 token often has mechanisms built in that require users to stake or lock up the native token, either to participate in network validation or maybe to secure the bridge between the layers.
Which takes supply off the market.
Correct. It reduces the circulating supply, making the price highly susceptible to upward pressure, especially when those adoption metrics start to spike.
Okay, so what kind of momentum or evidence would the analyst be citing right now to support this?
Well, we'd see them pointing to measurable ecosystem growth. You'd look for things like a significant increase in code commits on GitHub that signals intense ongoing developer activity.
A healthy sign.
Very healthy. They'd also cite rising total value locked, or TVL. That's the amount of capital actually locked within the protocol's smart contracts. A healthy, growing TVL, especially coupled with a growing number of unique wallets interacting with the protocol, that suggests real-world product-market fit. It's not just speculative trading volume.
But let's be critical here. What are the really significant challenges and, counter arguments to this highly optimistic crypto Bitcoin thesis? It sounds great, but what could go wrong?
Plenty. The primary risk, honestly, is market saturation and just fierce technological competition. The Layer 2 landscape is incredibly crowded, right? It's dominated by established Ethereum solutions that have a huge head start.
Yeah.
So if this Bitcoin-focused project fails to attract top developer talent, or if a competitor, maybe a very well-funded scaling solution, manages to roll out a superior technical architecture first, well, the analyst's thesis kind of crumbles instantly.
And what about security? Layer 2s connect to the main chain.
That's another huge one, bridge security.
Yep.
Layer 2s are only as secure as the bridges linking them to the main chain. We've seen major bridge hacks in the past, and a significant security breach would just wipe out investor confidence overnight. Irrecoverable, potentially.
And we can't overlook the execution risk that seems specific to these Layer 2s scalability bottlenecks, right?
Yeah, absolutely. If the network experiences unexpected congestion, or if the transaction validation process turns out to be slow or expensive under real stress, then the fundamental value proposition, the speed and low cost, it just vanishes instantly. The whole reason for its existence is gone. And tying back to tokenomics, which we just discussed, many of these scaling solutions have pretty aggressive vesting schedules for their tokens.
Meaning tokens unlock over time.
Right. So if the development team or large early venture investors are sitting on a massive impending token unlock date, that supply shock, that sudden flood of tokens hitting the market, can easily counteract any short-term fundamental gains. It creates substantial downward price pressure, regardless of how good the tech actually is.
Okay, that's a lot to consider for the tech bet. Let's pivot now to pick B, crypto XRP, targeting that even higher plus 355% gain. This one feels like the ultimate institutional and regulatory bet. We know its primary function is focused on institutional settlement, acting as a rapid, low-cost liquidity bridge for cross-border payments.
Yeah, XRP occupies a very distinct and focused niche in the market. Its core strength has always been its speed transactions are finalized in just seconds, and its explicit design for enterprise use cases. It's meant to act as a fiat currency transfer mechanism.
So the analyst here isn't really betting on complex DeFi innovation?
No, not at all. They are betting on adoption within the existing global financial plumbing. It's an infrastructure play.
So what fuels the specific plus 355% confidence level then? This prediction seems to rely less on, coding miracles and maybe more on legal paperwork.
You got it. The outsized confidence stems heavily from the potential for decisive legal and regulatory clarity, particularly in the U.S. The sources strongly suggest that a clear, favorable resolution to the project's long-standing regulatory struggles that would immediately remove the single largest barrier to widespread institutional adoption.
So clarity is the key.
Clarity is the absolute key here. It unlocks access to major global money transfer corridors, large banks, foreign exchange providers, basically all the big players who've likely been waiting on the sidelines for legal certainty before committing.
And if it captures even a small piece of that huge cross-border market.
Right. Think about it. The annual cross-border payments market is something like $150 trillion. If XRP manages to capture even a modest slice of that, well, suddenly that plus 355% prediction starts to look potentially conservative, doesn't it?
It certainly puts it in perspective. So the narrative here is basically the tech is mature, it's functional, it's ready to go. It's the legal status that provides the alpha, the potential for outsized return.
That's the core thesis.
What supporting evidence would we look for then? What would prove this thesis is playing out?
Well, you'd look for things like a massive spike in on-chain transaction counts and also the total transactional volume, especially if those transactions appear to be high-value transfers, which would signal institutional use rather than just retail trading activity.
Real usage, not just speculation.
Exactly. And beyond that, you'd look for confirmation of active production deployment. That means seeing major established financial entities publicly announcing they're actively using XRP for routine settlement operations, not just running small pilot programs or tests. The analyst is clearly betting heavily on this institutional buy-in narrative becoming reality.
Okay, but what are the fundamental counterarguments and risks for XRP hitting that 355% target? It can't be risk-free.
No. Definitely not. Execution risk remains paramount, even if the tech is mature. Can the team successfully integrate its technology with a highly complex, often decades-old legacy banking infrastructure of these large global institutions? That's a huge hurdle.
Integration is tough.
It is. Delays in integration or technical failures within these highly sensitive financial systems that could severely damage the trust needed for mass adoption. And trust is everything in finance. Furthermore, the large, somewhat centralized allocation of the token supply. While it might provide some stability, it does continue to generate market perception issues for purists who demand absolute decentralization.
Right. The decentralization debate is always there with XRP. And let's talk about those large token holder movements you mentioned earlier. Unlike a truly decentralized asset, XRP has these large, often programmed monthly releases from escrow, right?
That's correct.
So if these large holders, the so-called whales, decide to use positive news, like maybe that regulatory clarity finally arriving as a liquidity event to just sell off large amounts.
Yeah, that resulting supply shock could instantly overpower the positive sentiment. It could completely derail the analyst's price target, regardless of the good news. It's a significant overhang risk.
Okay, so comparing the two picks directly then, crypto Bitcoin, the layer 2 play, seems like the technological moonshot. High risk because it really depends on beating intense tech competition and executing flawlessly on a very ambitious, probably decentralized roadmap.
Right. The potential reward is capturing a slice of the entire Bitcoin economy, which is huge, but the execution risk is also huge.
Whereas XRP is more the regulatory and adoption bet. It feels like the relatively safer bet, and I use quotes around safer because this is still crypto.
Definitely relative terms, yes.
Because its success hinges less on creating brand new tech and much more on achieving regulatory acceptance and then penetrating a known existing market cross-border payments with a product that already exists.
Exactly. The analyst's conviction in each case lies in two completely different but both very high-stakes areas. One is betting on tech breakthroughs, the other on legal and business development breakthroughs.
Let's think bigger picture now. If either of these high-stakes predictions actually materializes, if we really see a crypto Bitcoin layer 2 or XRP hit those plus 300% to plus 400% targets, what does that signal about evolving investor expectations in this space? It feels like a significant shift.
Oh, absolutely. Games like that would signal that speculative capital hasn't just returned, it's returned with a vengeance, but it's becoming highly targeted.
Not just throwing money everywhere.
No. Investors would be actively moving capital away from maybe the slower, steadier accumulation of the mega caps, your BTC and ETH, and deliberately into projects that demonstrate clear, executable catalysts and, crucially, have a smaller market presence where those catalysts can have a bigger impact.
That sounds like classic sector rotation.
It's the very definition of sector rotation.
Yeah.
The hunt for asymmetric gains, where one successful catalyst provides a massive multiplier effect on the price.
But let's challenge the source logic a bit here. If Wall Street firms are making these highly aggressive, very public predictions, isn't there a risk they're simply attaching a flashy 400% label to something that's already inherently volatile? Maybe just to justify high margin trading or sell proprietary research or frankly just generate clicks and buzz.
Well, that's the inherent tension, isn't it? Right at the heart of this TradFi meets crypto interface. The analyst report itself acts as a massive narrative booster. There's no denying that.
The report is the news sometimes.
To an extent, yes. The mere fact that a recognized Wall Street firm covers a token and slaps an enormous price target on it, that creates a sense of legitimacy. It inevitably attracts retail capital, and it maybe gives more risk-averse institutional investors permission to look closer, to start their due diligence.
Okay.
However, and this is a big however, that narrative premium is usually a short-term phenomenon. If the underlying fundamentals don't follow through, if the execution isn't there, the code updates don't ship, the user adoption doesn't materialize, then that narrative just fades into history, and the price target gets quickly forgotten.
So we're constantly balancing this story or narrative premium against genuinely grounded fundamentals. We've seen historical parallels for this, haven't we? I mean, think of Solana's big rebound a while back.
Example.
It went through that deep, dark period, lots of technical failures, network outages, tons of negativity. But then when it successfully executed those technical fixes, attracted new developer talent, fostered new scaling solutions on top, the market pretty quickly reversed its fortunes dramatically.
Exactly. The catalyst, the fundamental execution, eventually met the narrative, and the price soared as a result. That's the classic pattern we're watching for here.
So the analyst report might be the ignition.
But the ongoing fundamental improvement is the fuel. Absolutely. If the team behind this hypothetical crypto Bitcoin layer 2 fails to deliver the promised opcodes on time, or if XRP fails to capitalize on any regulatory clarity with meaningful client onboarding, that narrative premium just evaporates, and the price will ultimately reflect the underlying missing utility.
And what does this whole trend Wall Street analysts increasingly covering what are still fundamentally quite speculative smaller cap names, what does that say about the evolving interface between traditional finance and crypto? Is it validation or something else?
I think it's primarily an affirmation of the asset class's inescapable maturity, or at least its profitability. TradFi simply can no longer afford to ignore the potential for high alpha opportunities in altcoins. They are, in effect, validating the market structure by participating.
So it is validation in a sense.
In a sense, yes. However, there is an inherent conflict, or maybe a tension. Analysts are pushing their credibility, their firm's reputation, into much riskier territory than they traditionally would. A 355% prediction isn't standard fare for a bank analyst.
No kidding.
It's designed to generate interest, yes. But it also signals that the relentless drive for high returns is pushing the traditional financial establishment into areas historically reserved for venture capital and pure speculation. You could say the financialization of the crypto market is becoming absolute.
Okay, we've established the massive potential upside, the allure of these plus 300% numbers, but now we absolutely must drill down hard into the risks. These optimistic models, whether they're based on technology or regulation, they frequently make some dangerous, often quite unrealistic assumptions, don't they? What are the common pitfalls we see?
Yeah, the primary pitfall, almost universally, is the assumption of near-perfect execution. Analyst models generally have to assume development teams will meet their roadmaps perfectly, on time, that no critical technical bugs will emerge during scaling, that the market itself will remain continuously liquid and favorable throughout the prediction period.
Which is rarely the case.
Rarely, if ever. The messy reality of decentralized development especially is that it's highly iterative. It's subject to delays, unexpected technical hurdles, governance disagreements, even just the unpredictable nature of human capital.
People involved.
Exactly. An analyst's spreadsheet cannot easily model the risk of a lead core developer quitting unexpectedly, or a crucial third-party security audit failing spectacularly right before launch. These things happen.
And liquidity. You mentioned liquidity. That feels like a massive immediate hazard, particularly because we were talking about potentially smaller tokens relative to behemoths like Bitcoin or Ether. Let's clearly define that danger for listeners. Flippage. What is it and why does it matter so much here?
Slippage is absolutely crucial, especially when you're dreaming of cashing out a 345% gain. If you try to realize that gain by selling a large position quickly, you may find that the market volume, the order book depth, simply isn't deep enough to absorb your sell order at the current quoted price.
So you don't get the price you see on the screen.
Precisely. Your order execution slips down the order book, forcing you to accept a lower average price, meaning the actual realized gain is significantly less than that headline target price.
Yeah.
And this happens much faster, much more dramatically in low liquidity assets. A flash crash in a small token can wipe out gains or even a large portion of your initial investment far faster than you might expect in highly liquid markets.
And these liquidity issues, they're often exacerbated by what you call token velocity events, specifically token unlocks.
Yeah.
We've seen this concept play out pretty dramatically with projects like SUI or Aptos when they hit their big vesting cliffs. Can you explain again how that supply shock impacts the price, even if the project itself is fundamentally strong?
Yeah, it's a critical concept. A vesting cliff, or a scheduled token unlock, occurs when large quantities of previously locked tokens, often held by early investors, the project foundation, or the core development team, are suddenly released into the circulating supply all at once.
A flood of supply.
Exactly. So, if a project is due for a massive scheduled supply increase on a specific date, it creates potentially overwhelming supply shock. Even if the project announces incredible partnership news that very same week, that sudden rush of selling pressure from unlocked tokens hitting the market can create a dramatic price drop. It can completely neutralize any positive fundamental news. It becomes a fundamental battle between positive catalysts and negative tokenomics.
Okay, that's a key risk. We also need to address the broader systemic and execution risks. For XRP, the regulatory risk is kind of obvious. It's central to the thesis. But let's broaden this out. Regulatory bans or just adverse clarity can instantly crater the valuation of any project operating in a perceived gray area, right? Like specific DeFi lending protocols or maybe certain decentralized exchanges.
That's absolutely right. And for our hypothetical crypto Bitcoin layer 2, if the SEC or other global regulators suddenly decide that its specific sidechain mechanism, or maybe its token structure, constitutes an unregistered security,
Game over?
pretty much, or if a major jurisdiction bans the specific use case it facilitates, the entire addressable market evaporates overnight. It's a constant, low-level existential threat for many projects in this space.
Then there's just the simple yet incredibly common execution risk. A team might promise a revolutionary upgrade in Q3. Sounds great on the roadmap.
Looks good on paper.
Right. But if they miss that deadline by 3 months or 6 months, maybe due to unforeseen technical complexities, the market's capital and, just as importantly, its focus often moves on. That shiny price target becomes irrelevant because the timeline needed to potentially achieve it just got pushed out indefinitely. The opportunity cost becomes too high for many investors.
And we absolutely cannot discount the ultimate macro risk. The sudden market sentiment flip, a surprise interest rate hike from the Fed, a major global geopolitical event, maybe a systemic liquidity crunch spilling over from the traditional financial sector. These things can cause risk-off sentiment to dominate instantly across the board.
And macro doesn't care about your project's roadmap.
Not one bit. These macro forces are completely indifferent to the specifics of a crypto project's fundamentals or how well its development team is executing. They simply wipe out speculative bubbles across all asset classes, often starting with the riskiest ones first.
It's really important, I think, to ground the listener's understanding here by just briefly reminding them of historical failures after the hype. We focus on the winners, but for every project that successfully navigates all these risks, like a Polygon or a Chainlink that delivered, there are dozens, maybe hundreds of others that were once touted for massive gains but later collapsed. Maybe due to poor execution, mounting technical debt, infighting, or simply because their core use case proved unviable in the real world. Understanding that worst-case scenario isn't pessimism. It's the absolute basis of effective risk management in this space.
Well said. You have to know the downside potential.
Okay, so the core of this deep dive really is providing you, the listener, with actionable knowledge. If you decide after hearing all this to follow up on the potential flagged by these analyst predictions, you absolutely cannot just watch the price chart flicker up and down. That tells you very little.
Right. Price is a lagging indicator, often driven by sentiment.
Exactly. You need specific, observable metrics to monitor the viability of the underlying analyst's thesis. We need ways to judge actual execution, not just ride the hype cycles.
And for that, we rely heavily on on-chain indicators. They help cut through a lot of the noise generated by analyst reports or social media buzz. First, let's talk about active addresses.
Okay, what does that tell us?
This is a fundamental measure of real user adoption. Is the user base genuinely growing over time? Or is the on-chain volume maybe being artificially inflated by just a few large trading entities, whales moving funds back and forth between their own wallets?
So we want to see broad-based growth.
Exactly. A healthy project typically shows a consistent, ideally linear increase in new active addresses joining the network over time. That signals expanding utility, that real people are finding a reason to use it.
Okay, active addresses. What else on chain?
Hand in hand with that is overall network activity. You monitor things like the total number of transactions happening on the chain and also the average transaction fees.
Why fees?
Well, high transaction counts are good, but if they're coupled with steady, predictable, and manageable fees, that's often a sign of a network facilitating real usage, not just being clogged by speculative trading or spam. If transaction counts are persistently low, however, the project might have a great roadmap on paper, but it suggests no one is actually finding value in the utility it currently offers.
Makes sense. Usage should drive activity.
Right. We also monitor token flows, specifically the net inflows and outflows from major centralized exchanges. This can give clues about holder sentiment.
How so?
If large holders are consistently moving tokens off the exchanges and into cold storage or private wallets, that's generally seen as a signal of accumulation and long-term confidence. They likely plan to hold, reducing readily available sell pressure.
And the reverse.
Conversely, if tokens are flowing onto exchanges in large volumes, particularly from known whale wallets, it typically signals an intent to sell in the near future. That creates potential downward supply pressure that you absolutely need to be aware of if you're considering the analyst's upside target.
Okay, those are key on-chain metrics, but beyond the raw blockchain data, we also need ways to judge the team's actual ability to deliver on the catalyst, right? The key performance indicators, or KPIs.
Absolutely. Are product launches and critical upgrade roadmaps actually being met on time? For our crypto Bitcoin Layer 2 example, if they promise a major upgrade for Q4 and then it slips to Q1 then Q2, that should be a massive red flag. It tells you the analyst's timeline for that plus 345% gain is probably fundamentally flawed because the execution isn't matching the plan.
Delays kill momentum.
They do. And another crucial leading indicator, often overlooked, is the health of the development community itself. We track developer activity by monitoring code commits on platforms like GitHub.
Looking at the actual coding work being done.
Yes. Are the core contributors committing code frequently? Are there new external developers joining the ecosystem, maybe building applications on top? A vibrant active code repository suggests a project with long-term momentum and resilience, even if the short-term price is volatile.
And a stagnant repo.
A stagnant or shrinking developer base is often a reliable early warning sign of impending failure or loss of direction.
Okay. Good leading indicator. Then we absolutely must return to the financial metrics, specifically tokenomics, which you emphasized earlier. You really have to track this meticulously.
You do. Closely watch those token release schedules we discussed. Are there big unlocks coming? What's the ongoing inflation rate of the token? And critically, what's the level of staking or other lockups?
Why are staking levels so important?
High staking rates are generally fantastic for price potential, because they effectively remove circulating supply from the market. Less available supply means any new demand has a potentially amplified impact on the price. Conversely, low lockup rates or high inflation rates mean that external forces, even positive catalysts like a partnership, will have a harder time driving the price up simply due to the constant supply dilution hitting a market.
Constantly fighting against new supply.
Precisely.
Okay, what about technical trading signals? Charts, patterns, indicators. Do they have a role?
They can be useful, but they require very careful context. You can look for classic breakout patterns, maybe significant volume spikes accompanying price moves, but you have to interpret them in relation to the actual news flow and the fundamental metrics we've discussed.
So don't trade charts in a vacuum.
Never. You can also watch indicators like the Relative Strength Index, the RSI. If the RSI hits extreme overbought levels repeatedly, maybe without corresponding fundamental news to justify it, it might signal investor fatigue. It could suggest the asset is temporarily overextended and a short-term pullback is due, irrespective of the long-term bullish thesis. It helps manage entry and exit timing, perhaps.
Got it. Context is key. Finally, wrapping this section up, what specific news catalysts should the listener be actively watching for? What would genuinely validate that the analyst's core thesis is actually playing out in the real world?
Okay, for the crypto XRP archetype, the absolute holy grail catalyst is, first, that decisive legal clarity confirmed by an official body, like a court ruling or clear regulatory guidance, followed immediately by proof of major traditional institutional adoption. Think a top-tier global bank publicly announcing they're signing on for using it for actual payment rail integration, not just a test.
Real-world usage by big players.
That's the validation. For the crypto Bitcoin Layer 2 archetype, the key catalyst would be the successful, stable launch of that crucial technological upgrade. Maybe the new opcode gets implemented smoothly, or the sidechain mechanism goes live without issues. And critically, that launch is immediately followed by a measurable, massive increase in lock value TVL on the platform, and clear evidence of new developers onboarding to build on it.
So tech delivery followed by adoption metrics.
Yes, these kinds of confirmed, verifiable events are what validate the analyst's original premise and start to justify the enormous risk associated with those triple-digit price targets. Without them, it's just speculation based on a report. Hashtag outro.
Wow. This has been an incredibly detailed and, I think, frankly, vital deep dive into the wild extremes of crypto prediction. So let's try and recap our core analysis here. These cybers plus 345% plus 355% calls, they are absolutely not investment mandates.
Not at all.
They are high-risk, high-potential gambles. They should really be used as powerful signals for deeper, targeted research focused entirely on execution, on the tokenomics, and on those verifiable on-chain fundamentals we just spent time detailing.
And we absolutely have to emphasize critical risk control again. The analysis of these two hypothetical picks really highlights two different types of major risk, doesn't it? Yeah. You've got the technological execution risk versus the regulatory and institutional adoption risk.
Two different paths to failure or success.
Exactly. So diversification, sizing your position appropriately for the specific risk profile of the bet you're considering. Those remain key. Encourage yourself, to constantly question the source logic behind any big prediction. Critically assess the team's actual demonstrated ability to execute their ambitious vision. And always check those tokenomics for any impending supply shocks that could derail the thesis.
Sound advice. So here is our provocative closing thought for you, the listener, to maybe consider. If one of these picks, let's say the regulatory bet archetype, XRP, actually achieves its massive target, but the other one, the technical execution bet, crypto Bitcoin, bombs spectacularly, what will that outcome teach us? What does it say about the predictability of market narrative versus those measurable, verifiable on-chain fundamentals?
It's a great question. What will you look for next time an analyst makes a similarly bold claim? Will you focus more on the story or on the data?
Food for thought.
Indeed. And look, we are absolutely committed to continuing to provide this kind of quality, timely crypto analysis, bringing you these deep dives into the most important and, often the most controversial topics happening in the space.
And speaking of that commitment, if you enjoyed this breakdown of the analyst picks, if you found this deep dive useful for your own thinking and research, please do take just a moment to subscribe, maybe leave a comment, and generally engage with the content.
It really helps.
It really does. Sharing your debate in the comments, like which pick you would bet on or what fundamental risk you see derailing the whole thesis, that actually helps support the channel quite a bit. It boosts our visibility in the algorithm, and frankly, it just lets us keep creating quality content like this for you. We genuinely appreciate the support.
We really do. So until the next deep dive, our advice remains the same. Remain skeptical, always do your own research, and manage your risk wisely.
We'll see you next time.